Good morning, good afternoon, or good evening, and welcome to all the Trade Day team to the Bull versus Bear webinar, even on Monday, the 8th of September. Here, Steve Miley on the call for Trade Day. Welcome, everyone. We're going to go through our usual Monday run through, which is slightly different to our normal daily run through, where we take a look at the shape of the week, as I like to call it, what's coming up for the week ahead, what also happened last week, what are the main macroeconomic fundamental center of bank geopolitical events that are shaping financial markets right here, right now, and into this week. Why do we do it at trade day when we're day trading at trade day? Why do you care what's happening on Wednesday, Thursday, Friday of the week if you're just trading for the next 30 seconds, 1 minute, 2 minute, 5 minute, 30 minutes? Because volatility can be different and expectations of volatility can be different. If we've got a heavily weighted, for example, data or geopolitical events expected maybe later in the week, it will probably mean that volatility is going to be quieter at the beginning of the week. And vice versa. If we've got a big event coming up today or tomorrow, you need to be aware of that because the market might be more volatile in the short term. So we'll take a look at that and we'll run through. So the two documents we publish each weekend usually come out on a Sunday. Are the longer macro matters. You can see 4 pages in it going into depth of what happened last week and what we've got coming up. And then the macro summary in here, basically just a summary of that. You can get that in the middle sections, 3 sections below where you're watching this. If you're watching this live in the members area, we have the left-hand column where we get the macro watch. These are from me, macro watch. Daily technicals. So here we have the macro watch from me. This is me, market chartist. You get the technicals on S&P, Nasdaq, gold, and oil, and then we get the treasuries in here: 30-year, 10-year. 5-year and 2-year note. So we get all of those technicals. That's in the left-hand column. The middle column is where we get these: the macro summary and the macro matters. Reports in here posted every weekend, once a week. And then on the right-hand column, you get the news from our partners at Live Squawk, who also provide the Squawk service, the live audio Squawk service. If you haven't used that, I would certainly recommend having that turned on. That's an extra perk you get here at Trade Day for being a member. So we have the Live Squawk, and then we also have the on the right-hand column is the scrolling news service. So they put out 3 news reports a day from Europe, Asia, and the US, and then also you get scrolling news in there as well. So all of that should be monitored and are resources that you should be using. So let's get into it for today. What happened last week? Well, stocks were higher again. US averages hit and closed near to record highs at the end of last week. Global, it's not just US stocks, global stocks higher. The Euro stocks 600, that's the pan-European index, did dip 0.2%. And German's DAX and France's CAC losing ground, but the FTSE was up. Japan's Nikkei was up. Hong Kong Hang Seng was up as well. So markets generally doing well last week. We are getting growing expectations of not just, nailed on really, that we're going to get a September rate cut, but maybe more aggressive rate cuts from the Fed going into the end of the year. And that was fueled both from Fed speakers, and also from the data, and we'll talk about the data now. The data in the middle of the week showed that while service sector PMI is the Purchasing Managers Index, the US ISM Purchasing Managers Index data was strong on the service sector in here, so here we see, this is the paragraph from the service sector showing great resilience, but the manufacturing contracted, the manufacturing PMI data contracted for a 6th straight month, so that's a negative, certainly a negative. And PMI is an important piece of data, Purchasing Managers Index. It's a survey of purchasing managers. These are the guys looking up and down the supply chain. It's been shown to be an excellent lead indicator of where the economy is going. So manufacturing certainly looking like it's negative. And then the other big piece of data that was then on Friday, with the market actually kind of whipsawed around this, but generally seen as potentially a positive for the market, even though the labor market was negative. So this labor report showed that jobs added were just 22,000 in August, with an expectation around 75,000. The unemployment rate also edged higher on Friday to 4.3%, the highest in over 2 years. And this was on the back of the ADP private payrolls number and the jobs reports, or the JOLTS report, the job openings report as well. So all of these things in here Job openings fell to their lowest since 2020. So all of this is looking a little bit negative, and that has then increased the chances of the Fed cutting rates. Now the markets are looking at this. Well, is it negative that the economy is slowing and the labour market's not as strong? Is that a negative? Because that's obviously a negative for the overall economy. It's a negative for the consumer. It's a negative for potential spending, etc. Okay, but you have to weigh that against, well, this could mean then the Fed are more likely to be more dovish meaning more likely to cut interest rates more aggressively. And if they do that, then that's a positive for the market. Lower interest rates generally better for equities, generally better, and then should stimulate the economy. So the markets were kind of choppy on Friday, but nevertheless, the overall outcome seems to be more positive. Looking into this week, two main events, and one probably less important for us on the US side, trading US markets. In the ECB is this week on Thursday. No rate cut expected. A couple of articles on we're going to explore as we go through today from the major news wires, but no rate cut expected. But what will be significant is they are publishing outlook data, and then we've also got some the political backdrop of France in here. No confidence vote potentially coming through with potential fiscal implications from France. We've also got stuff going on with Japan with looking like a change of government in Japan. So on the political front, things both in Europe and Asia are looking a little bit negative. The main piece of data of the week is going to be the US CPI data we got on Thursday. PPI on Wednesday. CPI data on Thursday. That's going to be the critical data, and then just see how that affects the expectation from the Fed, which we have the week after. So if we look into today, you see there's pretty much nothing on the agenda for today. But if we go to, and then the other thing of note is, remember we're on the Fed blackout period, so we get no Fed speakers this week, okay, or next week in the run up to the meeting on the 17th. Oops, that's the wrong one. Where are we? September. Am I on the right year? Yeah, there we go. September, where are we? No, 2026. 2025. Here we are, 16th, 17th. They've done away with that old sheet in here that was in here before. Here we are, 16th and 17th. So we're on the blackout period now. 16th, 17th next week, Tuesday, Wednesday, with the result coming on Wednesday. So all our eyes are going to be on that. And how is the data we have this Thursday from the CPI going to impact onto that? Let's go to the major news wires. Nothing really huge in here on the Morning Briefing America from Bloomberg. ICE raids unfold in Boston, Chicago in view. I mean, this is not going to impact into financial markets. Nothing in here really impacting into markets. Follow through from OPEC, agreed to raise production in here, oil lower last week. And then, so none of this in here is impacting. This here is talking about Japan. In here, France, political mess poses a long-lasting risk to stocks and bonds. So that's in view as well, both the political situation in Japan and France. Moving on, global stocks rally. So we had a recovery rally in here this morning in Asia and Europe as traders brace for a busy week. So stocks generally higher in here. And European shares rise ahead of crucial French no confidence vote. So despite that no confidence vote, which is anticipated to lose the no confidence vote, European stocks are up this morning. Fed rate cut optimum lifts stock sentiment, eyes on French and Japanese politics. We've already mentioned that. Are we, and this is the ECB coming up on Thursday, are we done already? 5 questions for markets ahead of the ECB. We'll revisit that closer to on Thursday when the meeting comes up. As I said, the global stocks are up this morning. The Japanese Nikkei up nearly 1.5%. The Hang Seng up 0.85 this morning. European exchanges are up, only slightly higher on the UK FTSE at 1/10 up, but the German DAX up 0.7, and the French CAC up nearly 0.3. And US futures are up this morning with the S&P up just under 0.25% and the Nasdaq up just over 1/3%. If we go to the Fed Watch tool, this column has appeared from nowhere now. So pretty much there's no column here now for no rate cut. So we're currently at 425 to 450. So there was a column here, that column has disappeared now. So the market is not pricing in any chance that rates are the same come 17th September. Okay, in here we have a 90% chance that they're going to be cut 25, but now we've got nearly 10% chance pricing in of a 50 basis point cut coming at the September meeting. That's the first time that column's appeared, and the other column for no rate cut has disappeared. On the 29th of October now, we've got only an 18% chance that we've only got one rate cut, so the market is pricing in a second rate cut and potentially up to 75 basis points, nearly a 10% chance that we are 75 basis points down by the October meeting. And remember, it was like 50-50 between 2 rate cuts and 3 rate cuts, or a total of 75 by the end of the year. Now, if we go to here, this is the chance of only one rate cut, only 1%. This is a 50 basis points down. So now we've got in here, if we add all this together, there's only an 8% chance in here that, so the market's pricing in pretty much nailing on. We've got 60, let's say 67 and 8, the 75% chance now we've got 3 rate cuts or more, and this is now for 100 basis points. So there's 8% chance of 100 basis points, but the market now pricing in of 3/4. It was about 50-50, now 75% chance that we get 3 rate cuts by the end of the year. So more chance now we're going to get 25, 25, 25 September, October and December. And that's reflected in the yield chart. So we go in the 30-year. Remember, the 30-year had tracked up last week to 5% in here with concerns. It wasn't really the US, it was more other countries in here, UK and Japan notably, going to multi-year, multi-decade high yields at the long end, at the 30-year bonds. And the US Treasuries were tracking higher as well, nearly just touching 5% in here. But a complete reversal of that last week in here, back on Friday, and back to the other end of the range, all on Friday in here. So yields plummeting lower. So here on the 30-year, going to the lower end of this range from the upper end of the range. And look at the 10-year in here, tracking significantly lower the second half of last week, now going into yields. Oh, this was, remember when Trump did the tariffs, was it, what we called it, Liberation Day, I think it was. But when he announced the tariffs, we went to lower yields. But outside of that, we're pretty much at the lowest yields in here since October of last year on the 10-year. So across the board, if we look on our analysis, 30-year spiking higher to new highs, new price highs, 10-year really significantly higher, 5s as well, and 2s all pushing significantly higher, pricing in 2 things: one, more aggressive rate cuts from the Fed, but also an anticipation of a soft landing, that the economy is going to be okay. So all of that is pretty positive overall. Equities did make new highs at the end of last week. S&P 500 at a new high, did back off from that on Friday, but obviously, as we said, rebounding again this morning. And the Nasdaq, not quite a new highs, but taking out peaks we saw a few weeks earlier, and looking very positive compared to where we have been. Looked like it was a potential topping pattern. Nasdaq rebounding strongly in here and pointing higher again, and obviously a little setback on Friday, but obviously back higher again in here this morning. So overall, equities looking bullish, running bullish into today. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe, and we'll be back with you with another bull versus bear webinar tomorrow. Bye.